Hey everyone, today I'm sharing a story that's a bit different from the usual success tales we often see in the trading world. Social media has this way of shining the spotlight on just the wins, making it easy to forget that behind every victory are days loaded with valuable lessons learned through facing challenges. As traders, we're on a journey that's filled with thrilling highs and some pretty tough lows, and today I'm sharing one of those not so stellar experiences. The story played out during my trading ventures in March. Today, March 31st, is when this will be uploaded. To give you some context, I'll be sharing a glimpse of my equity curve of my fund accounts for the month. All my trades are documented live on YouTube, and those familiar with my approach know I maintain small losses due to my tight risk tolerance. However, towards the month's end, a simple sizing mistake set off a domino effect of errors, erasing my profits from three fund accounts, leading to a total loss of $15,000 all within a single day. My intention in sharing this isn't to seek sympathy, but to dissect my error in the hope that you might learn from it and steer clear of similar pitfalls. It's all about portraying the genuine aspect of trading and maintaining transparency with all of you. So let's get started with what happened. I usually kick off my trading around 20 minutes after the market opens, and that's when you can catch me on YouTube live streams. And I steer clear of the open market volatility just because it's like a double edged sword and it has a potential to either greatly benefit you or hurt you just as fast. And on that fateful day, just before my live stream, I attempted a quick scalp during the open market volatility with one contract aiming for a maximum loss of $200, which translates to a 10-point stop, which is normal to me. And unbeknownst to me, my ATM bracket order had a preset of four contracts, which is four times what I would have entered. And as soon as I entered the trade, my loss showed high 500s immediately in the negative, and the shock of realizing my sizing error made me emotional, prompting me to adjust my stop in the hopes of salvaging the trade. This is a classic example of how trading with emotions can cloud your judgment and why it's crucial to aim for emotionless mechanical trading. Just a few minutes later, I found myself down negative $2,000 and hitting my final stop. Being the whole $2,000 that quickly from a mistake is tough, but something you can recover from over a few weeks of consistent trading. Yet, I was already swayed by my emotions and began to tilt. I was determined to recoup my losses quickly, and within the first 30 minutes of New York Open, I recklessly hit my maximum loss on these three funded accounts, a staggering $4,500 loss across three fund accounts and additional negative $1,500 on a my funded future account, culminating in a total loss of $15,000 in profits. Money I could have withdrawn at any time since I was well above the payout threshold. This disaster all began because I tried to do a quick scalp during peak volatility, along with strong price action before my normal trading kill zone. And unfortunately, I overlooked the ATM bracket I had on, which preset my sizing. The story serves as a potent reminder that even the most disciplined and risk aware traders can falter due to a single lapse of judgment, leading to emotional trading and a chain reaction of poor decisions. So, where do we go from here? How can we stop this from happening again? I made some notes about what I will be looking to do and also asked Twitter what they did when they had a significant setback to the trading because of overtrading, revenge trading, emotional trading, or even just full tilting. And here is what I compiled to help you stay on track. First slide is develop a structured trading system. First point, do you have a plan? You want to focus on one model, whatever the trading model is, just hone that in and trade that one model so you don't confuse yourself with other confluences. And also, along with that, one asset. If you're trading indexes, trading NQ, trading ES, don't try to trade Bitcoin, don't try to trade gold because those instruments move drastically different. Next point, repeat consistent trading times. If you normally trade New York morning, New York open, and all that, and PM, and it's your first time trying to trade Asia and you just get tempted to trade on your phone, don't do that. Just try to focus on trading what you're used to. Next, always be prepared. Did you create a bias? Do you know what the draw liquidity is? Have you seen the new drivers of the roadmap of the week? Next point, no entry and exit. So when you enter a trade, do you know where your stop is? Do you know where your TP, where your final entry or exit is? And also using hard stops, you can have controlled risks. That's how you want to stay mechanical. You don't want to trade based on feel. And lastly, when are you clocking out? After a certain amount of wins, let's say you keep on winning, three trades in a row, you made $400 on each one of them. Now you're up 1,200. Can you stop at that? And vice versa. If you're losing, can you shut off the screen? These are part of your planning and part of your discipline. Psychology, the mental block of trading. You want to set realistic goals, whether it's weekly, monthly, quarterly, yearly, whatever it is. You want to just focus on your goals and slowly progress as a trader, whether it's wins or losses, and ignoring other people's results because it doesn't dictate or influence what you're going to be doing. Next is you want to keep your trading structured. Follow the game plan. Whatever your game plan you had previous slide, stick to it, stick true to your plan. Controlled emotions. Emotions are very difficult to manage, but if you're trading with a system, this would help. Next is fear and greed. Are you exiting too early? Are you over trading? Do you want more profits? These are the type of things you just want to be more mechanical in so you don't deviate from your plan. And patient and disciplined with your trading. If your setup doesn't come, you don't have to place a trade. The market's not going to go anywhere. So you just want to wait for your A plus setup, whatever it is, and just wait for the setup to come to you instead of chasing it. Acknowledge losses, and it varies with months. There'll be some months where you can have a 70% win rate. Other months where you can have even below sub 50%. You just have to acknowledge those losses and keep on refining your trading style. And lastly, proper risk management. This becomes more about your risk tolerance. If you're trying to make a trade and try to go for 2R, let's say make $500, you should always have a max controlled risk. Don't try to lose more than you make, and just have a reasonable loss per trade and expect that when you enter a trade. So last slide is reflect, document, improve. You'll take some time off the charts to cool down and have a clear judgment and reflect on your mistakes. You want to document everything that happened in detail. What was the setup? What happened? When? The outcome, and identify all your emotions at the time of the incident. And then you can also discuss your downfalls with others. When people make mistakes, you can speak onto them. So you can learn from others, and when speaking to others, also helps acknowledge your mistakes. Review your training plan. You broke them. There's always something that happens and you break them. You want to understand why we have a system and follow through with it. Next, you meditate. There's a lot of people that have been recommending meditation helps to have a clear mind when trading. And trading journaling all your trades, whether it's win and losses, definitely helps into becoming more of a consistent trader. And lastly, remember the mistake. You have to forgive and move on. If you had a trade where you lost $100,000, and then next few months you're always thinking about like, what if I didn't do this? What if I didn't do this? You want to forgive and move on. You already reflected it. You're already documented it, and now we're moving on from it, so we can learn and improve as a trader. And that is all for this PowerPoint.